Kentucky Investment Advisory Committee, the 30th day of October 2025 in Commissioners' Chambers. We'll begin with a call to order. Mr. Secretary, would you call the roll?
Commissioner Plechnik,
Present.
Commissioner Beveridge,
Here.
and Treasurer Zurin here.
Next, we have approval of the minutes for the meeting of July 10th, 2025. Do I have a motion to approve, waiving reading of the same?
So moved. Go ahead.
Motion to approve the minutes as presented.
Second.
All in favor?
Aye.
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 It is unanimous. The minutes are approved. Do we have any old business to come before the committee? Any old business? Hearing none, on to new business and our investment review with Ms. Stanek.
Thank you, and good morning. Really appreciate the opportunity to come out in this wet fall day. Very interesting times we are living in, and I know we need to keep this pretty concise here. So just going through really what's happening in the markets here. As we know, the Fed did meet yesterday. They did opt to lower that overnight rate by 25 basis points. We're now in a range of 3.75% to 4%. That would mean that short-term interest rates will follow suit. Longer-term rates have already moved somewhat in advance of that movement because they're clearly driven based on the outlook for economic growth and inflation. And when we look at the inflation picture, we have seen inflation's been rather stagnant, hanging out around the 3% level. Thought it was interesting when Chairman Powell gave his the presser yesterday, and they talked about inflation, and the measure that they follow is at 2.8%. He basically alluded to, well, we're kind of starts with a 2, and so we know that's their target is 2% inflation. So even though it is higher than expected, he did downplay the current inflation rate, but of course added in the caveat that the impact of tariffs is still an uncertain factor here because not all of the tariffs have been agreed upon, and questions remain as it relates to whether companies will be able to just absorb those higher prices, or whether they will through their margins, or will they need to pass some of those cost increases also more so onto the consumer, which we know the consumer has already experienced a significant amount of inflation. Growth in the U.S. economy has been strong. Last quarter's growth was 3.8%. Today, we would have received the first read on the third quarter growth, but the government shutdown is creating this void of official data where every market participant, including the Fed, does not have the numbers that they would normally have to really gauge what the state of the U.S. economy is, what the state of the labor market is, and the like. However, there are private sources of data that are, relatively, I would say, accurate, that are being relied upon to backfill this void of economic data coming out of the U.S. government. As it relates to the shutdown, we're on day 30 of the shutdown. This is not the longest shutdown yet. There have been, since 1976, 20 government shutdowns. The longest was 35 days. That was back in 2019. And we won't get into the reasons why this one hasn't been resolved yet. But clearly, it does present some challenges, not only from the economic data standpoint, but also, not knowing really what will be the full-on effect on economic activity, considering that there has been a downturn in economic activity during the slowdown, and not all of that will be recouped once the government does go back to work. Employment numbers have started to turn the corner, starting to show signs of weakness. One of the biggest factors that has led to this is when the Bureau of Labor Statistics completed their annual update to the numbers by bringing in the data from the states. So each state reports actual payroll data to the Bureau of Labor Statistics. They then compile that and do a look back and revise the numbers from the previous year. So that March of 24 to March of 25, job growth numbers were revised down 911,000. jobs. And that was a very significant because traditionally that revision has been more in the neighborhood of around 250,000. So when we think in terms of, the Fed was keeping rates on hold for so long, and they were attributing the need to keep rates where they were because the balance of risks was tilted towards inflation, and the labor market was solid, strong. Those were the adjectives they used to describe it. Now that the more refined data has come in, the realization has become, well, that labor market was not as strong as originally anticipated. And so this gave the Fed the ability, we feel that gave them that ability then to say, okay, now our risks are more so on the employment side. And of course, we have seen that also when we've seen the new farm payroll numbers that did come in for September. August, they were significantly light. The estimate for September, because we've not received an employment report, is that the payroll numbers will continue to be light. The narrative has now shifted, we would say, whether rightly or wrongly, to the concept of, well, how many jobs really does the U.S. need to create in order to maintain this equilibrium of, new entrants into the labor market being employed. And there's some talk out there that, well, maybe that number is 0, maybe that number is 50,000, significantly down from the previous kind of accepted range of around 150,000. So again, we're having a lot of uncertainty in the marketplace, even as it relates to really what's the proper level of jobs. We do know that one factor that potentially will negatively impact employment will be, of course, AI. As companies that are in the forefront embracing the AI revolution, we have already started to see layoffs to that effect, the first one being Amazon, who just announced that they would be laying off 10% of their corporate headquarters. And part of the reason for that was efficiencies gained through AI. So clearly, very uncertain times in many factors, whereby we have the Fed who already had embarked on lowering rates. We've had those 2 rate cuts this year. They've also have thrown out that, well, maybe the December rate cut is not certain. That things could change. We're not sure that those changes will occur. The street is also expecting that the rate cuts will continue with December and will continue into 2026 as well. And we can see that particularly here when we look at the Fed funds futures market. This was run prior to yesterday's. We can see that was run the 24th. If I looked this morning at the Fed funds futures, and there is still, as I said, expectations for a December rate cut, and then additional rate cuts in 26. 2 rate cuts now as opposed to expectations of 3. But I think the overall message is that it's the direction of interest rates that hasn't changed. It may be just the pace of rate cuts. That may change here. We talked about inflation here real quick. Just want to move forward. GDP, as we know, we're kind of running blind. We don't know what the actual GDP number is for the third quarter. There have been some estimates that have come out that have said, well, it's probably more like the third quarter is maybe 2.5%, 3%. Clearly, though, the economists that are surveyed by Bloomberg have a more conservative view, not only as it relates to this third quarter GDP, but also the GDP numbers going forward. One of the things we want to comment on is just we know there's a lot in the works as far as pro-growth policies which would be positive to economic growth in the U.S. However, these policies will take some time till we really start to feel the benefits of them. Non-farm payrolls, we already talked about that. We could see the trend on the non-farm payrolls, the 3-month average certainly showed here a downward trend in job growth. And then, of course, the change in rates. Interest rates are lower than what they were previously in the year. What we're graphing here is on the top line the Fed funds effective rate and then the 2-year Treasury rate. The 2-year Treasury rate tends to lead the Fed funds rate by 6 to 12 months. So that being said, with the 2-year rate, today I think it's running around a 3.55 or so, would indicate that Again, the future path of rates here in the short term is lower rates. So moving on to the county's investment portfolio. We ended the quarter $144 million in cash, $261 million in securities. We're a little overweighted on cash with 35% of the core dollars of the county in cash, and that's because of taking advantage of those opportunities that the local banks are offering, as well as making sure we'll have sufficient funds available to pay for the Safety Service Center. But looking at the bottom portion, we can see when we look at the yields that we do have locked in based on the maturity buckets. Looking at our securities that are locked in beyond 2 years and beyond, we do have 33% of the investment portfolio locked in at over 4%. And this quarter, we do have $38 million maturing, so that's about 13% of the portfolio is maturing here in the fourth quarter.
Ms. Stanek, I'd like to interject right here, and first of all, I'd like to thank you for your expertise and
Thank you.
all your hard work in trying to maximize the portfolio return. There's a few things I want to point out on this chart. First of all, I want to just reiterate on the cash portion. A lot of those are investments in our local community at local banks. They offer a higher yield. We worked with quite a few of our Lake County banks and credit unions to invest money, and they pay a higher percentage than we were able to get at Star or were able to get on treasuries or corporate bonds or commercial paper. So we think that is definitely worthwhile, and also being involved in the community. I'd also like to go into more depth on the maturing securities over till the end of the year. We do have $38 million. About 1/3 of that is investments that we purchased about 5 years ago, and that was during COVID. Those maturing securities are paying less than 1%. We're going to be able to reinvest them for between 3.5% and 3.75%, which will be a little boost to the return for the portfolio. But when we do make investments, we always consider when the money is needed. So that will have a factor in how long the investment term is, but that should actually be very positive for the investment portfolio. And I'd also like to just state, what has happened, just a general statement about the portfolio. In 2021, the year I came into office, the return was $1.5 million, and this year the projected return is $26 million. So I just want to say that we worked really hard to understand when the money's needed, what we can invest, getting the local community involved, and looking at every single investment opportunity that's out there to maximize the return for the county. Thank you.
Thank you. And I would just follow on the treasurer's comment. We do have to bear in mind as a county that while we've seen our interest return go up, we've also seen our interest expense go up. So it hasn't been a bonanza. We've actually had to take out a very significant series of loans for the new safety center. And in the past, we've gotten notes for under 1%, just like we've gotten returns under 1%, but we've had to go for a substantially higher interest rate there as well. So that takes nothing away from the excellent portfolio management that we have from Ms. Stanek and the Investment Advisory Committee. I agree, it's been an exemplary job, but we do need to remember that as we celebrate the higher interest rate return, we also have a much higher interest rate expense, and so that tempers the real benefit to the county.
Both sides of the balance sheet, yes. All right, any other questions or comments? That will complete my report then. Thank you.
Thank you.
Thank you.
Any other new business? Any other new business? Hearing none, we will adjourn at 9:59.